Financials is what we are continuing to focus on. I think we have the Federal Bank management with us.
Well, that's right. Let's get straight to Mr. Harsh Dugar, the Executive Director at Federal Bank. Good morning, sir, and thanks a lot for joining in here on CNBC-TV18.
Good morning, Nigel, and thank you.
Let's get to a couple of aspects then. Your growth has slowed down a little bit. Could you tell us what is the outlook from here on? I believe that you're planning on outpacing the industry growth from here on. So what kind of growth are you looking at for the industry?
Okay, so I'll take a step back. I'll speak about the quarter first. If you look at it, 1/4 of our assets was basically in gold and housing loan. And housing loan, we had consciously decided to go slow, given that the pricing was sometimes bordering towards irrationality. So that was one. And gold, because of the regulatory announcements, and there was a little bit of an ambiguity, and different players were interpreting it different way, led to a marginal degrowth. But if you look at it otherwise, we have been growing some of our assets, which we have been saying the medium yielding assets, in a reasonably good manner. If you look at our MSME book, it's been growing at 20% YOY. If you look at our cards business, it's about 19%. So we're looking at growing our core mid-yielding assets and high-yielding assets in a significantly better way. So the idea would be to have a thrust and focus more on the medium-yielding assets, and subsequently, as we progress during the course of the year, on the high-yielding assets. So this is how we are. In terms of how we are guiding, we have always been saying that 1.2 times to 1.4 times of the nominal GDP growth is where we are looking to peg our growth rate on advances as. So this is where we would like to guide the markets at.
Okay, in percentage terms, so what would that be? You're aiming to deliver around 1.2 to 1.5 times of banking system growth, right? So what are you factoring in for the banking system then?
So we are seeing that banking system looks to grow at about 12%, 12 to 13% is what people have been saying that. So we've been saying that about 15 to 17% would be a broad range. It obviously depends upon the outlook. The tariff wars have also created some sort of an ambiguity in the minds of many of the corporates. So we look at how this shapes out. But broadly, what we are guiding is about 1.2 to 1.4 times over and gain market share on the advances piece.
Okay, got it. All right. We're just hoping that tonight we don't hear anything coming in from Mr. Trump. Everyone wants to have a good weekend. He doesn't seem to be giving everyone, too much of sleep. But let's focus on your business. Where do you see your CD ratio settle at?
So CD ratio is about 83% odd. We've been saying that about 85%. We plan to we always believe in fund before you lend kind of an approach. The good part is in the last couple of months, the pressure on deposit has actually eased out. RBI has actually infused substantial amount of liquidity between a CRR cut, OMO operations, and other steps taken by the RBI. So there is surplus in the system right now. Deposit rates have fallen. So to that extent, I would say that the CD ratio doesn't look to be under pressure at this point in time. And also the advances growth for the system as a whole, if you ask me, has slowed down a bit, partly because of the unsecured PL is slowing down, the corporate book in general for the system as a whole slowing down. So the CD ratio is not under pressure for us or for the system as such now.
Mr. Dugar, hi, good morning. Could you give us a sense on, I think so high-yielding loans, is that, what's the as a total percentage of total loan book, what is that at?
So as a percentage of our total loan book between high and very high yielding assets, just about 5%. This constitutes of credit card, PL and MFI loans. So in credit cards, we've seen a growth coming in and we've seen a reasonably robust growth. In personal loan, because of the stress in the system last financial year, we had consciously gone slow, but we're looking to getting this back again in this current year. MFI, we would like to wait and watch for 1 or 2 more quarters to see how things seems to be bottoming out. And there seems to be some green shoots in terms of collection efficiency improving. But there are certain states where we are still watching it very carefully as to how that will shape up. Karnataka, Tamil Nadu now after the recent announcement. We would like to be watching it closely before we take a call to grow this book. We grow the MFI book for sure, but not at this point of time. We'd like to take a bit of a pause, be a little cautious and calibrate the growth.
This sharp, it's only 5% of the book, but it's this sharp deceleration, right? About 10% growth now compared to 20% plus same quarter last year. Some of it, of course, is deliberate as well, as you're pointing out.
It was quite conscious, yeah. It was quite a conscious call. See, it's easy to grow this book. It's never difficult for any bank, for that matter, to grow this book. It's a conscious call that you don't want growth over asset quality. And asset quality remains, because it's more important that you get back your money, what you lend. So that's what the focus is.
Yeah. So on an overall basis, what were loan yields at in this quarter, the quarter gone by, and what can we expect on margins? Is there going to be a slightly downward pressure, even with rate cuts, etc., coming through?
The yields we obviously did because we've already seen two repo cuts, one happened in Q4 and one in the current quarter. So definitely the yields are under pressure and likely to be because most of the people are expecting two further rate cuts to happen, if not more, at this point in time. So there will be, and what typically happens, the yield comes off before the cost of deposit starts coming down, right? So the NIMs will always do a catch up with a lag. So we do expect the NIMs to be under pressure. Answer is yes. Now, how are we addressing this issue? There are a couple of things which we have done. If you recall that we already on the first few banks to cut down the rates on a savings bank by about 25 basis points. So that's come after the two rate cuts. That's number one, which would help us. Second, the thrust is more on the CAR piece of it when we're doing a deposit mobilization. So if you look at it, the CAR growth in particular for the bank has been very good in the last financial year. We grew about 35-36% in the last financial year on the CAR piece itself. And that's zero cost funds for us. So the share of CAR in our overall book was at 6%. And today in March 25, as we spoke about, was well above 7%. So the mix in the liability side is also changing. That's the second part. Deposits have also been repriced, but that will be for fresh. And hence the benefit of a lower cost of deposits will come with a little bit of a lag. On the asset side, 50% of our book is actually repo linked. So that obviously faces pressure. But over here also what we are looking at doing is we can do the interest reset at T+1, which we are on the few banks. We're looking at moving it to anniversary dates plus 3 months, which is regulatory permissible. So this will give us some time of a lag to reprice our asset book also. The another piece on the asset side is regarding the asset mix, like I mentioned earlier. So the focus will very clearly be on the medium yielding assets, commercial vehicles in particular. We are looking to grow that book sharply. We grew 35% last year, and we're looking to grow that also this year. MSME remains a clear focus. We grew out the MSME book as a whole, we grew about 20%. We're looking to grow that again in a significantly better manner. So between a good asset mix, managing your yields because of the repo cuts, looking at fixed rate loans wherever we possibly can, are the various steps which has been taken by the bank in terms of ensuring that we kind of reduce the pressure on the NIM.
All right. Closing comments before we let you go, Mr. Dugar. NIMs, what does it mean? The benefits of lower cost deposits will flow in with a lag. You also said yields a little bit under pressure. What is the NIMs you should be working with? And I'm looking at the slippages. Last couple of quarters, it's been ballpark around 500 crores. How is this number likely to pan out? Please go ahead.
So if you look at it, our asset quality has been at a decadal best. Our GNP at 1.84 and net NPA at 0.44, which has been good. Our credit cost for the quarter was about 26 basis points. And for the full year, just about 38 basis points. We have been consistent of being conservative and ensuring our asset quality. So I don't think we see a threat. We've been guiding the market at 40 to 50 basis points in terms of credit cost, which is what we are maintaining at this point in time as well. And we don't see, very frankly, any significant stress or anything blowing up which will cause any kind of a concern. The MFI stress, which was of a concern, seems to be bottoming out. We'll watch for a quarter or two more, but this is where we are at. So if I have to guide you for an asset quality in terms of credit costs, I think we are guiding at about 40, 45, 50 basis points.
Got it. We'll leave it there. Thank you very much, Mr. Dugar, for joining us. We wish you all the best of luck as you get into F5 26.